But I also think it's interesting from an investment standpoint, just as part of, it's one part of this commodity super cycle that, as you point out, demand is only going to continue to grow for the stuff, and it's limited in supply, and not just naturally limited, but also limited by the lack of investment. And so, but these are the dynamics that are true in almost every market for hard assets that you'd want to look at. And it's just fascinating to me to see, these things do well, over the last, 5 years, 10 years in the case of precious metals, and still there's no interest in them, right? It's like, it makes me wonder, how much do the prices of these things have to go up before investors really, sit up and go, hey, I need to participate in this. And I think we're going to find out. All that tells you is the returns in those areas is going to be a massive oversupply of AI and all this kind of stuff, in terms of the hardware and data centers. We're going to see a crash in returns. I mean, that's just how the capital cycle works. And the dramatic underinvestment in the production of commodities and energy and these types of things is going to sustain a bull market in that area for a long time to come.
Yeah, so it sounds like you are in the camp of a commodity super cycle, and you're pro all forms of energy.
Absolutely. I mean, I mentioned my friends at Gehring and Rosenzweig, and they've done some great work. And if you just look at the ratio of the Dow Jones Industrial Average to, the Goldman Sachs Commodity Index or something like that, it's almost, it's a generational opportunity still in commodities. Even though we've seen a boom in commodities prices, copper prices rebounded, significantly in the last few years. Gold prices up really nice over the last 10 years. Oil prices since 2020 have rebounded really nicely. They're still so dramatically cheap relative to financial assets that it's almost incredible.
Yeah. So, Jesse, here's another business site headline from late last week. The Dow rises more than 400 points, touches new record above 40,000 as investors see bull market broadening beyond technology. Are you in the camp of a blow off top, crack up boom type event in the markets that is positively impacting just about every sector, and then a .com type drop, or do you foresee something else taking place?
No, that's pretty much what I see. So, I've mentioned a couple times so far this year on, in other interviews that, the insider sell to buy ratio is almost off the charts. That's usually a really good signal for, like I said, 12 to 24 months out in terms of where's the economy headed, where's earnings headed, where's the market headed. But we've also seen a number of, breath warnings, and this has become a more popular topic, on financial Twitter and in the mainstream financial media even recently, as we've seen a number of Hindenburg omens triggered, a number of Titanic syndromes triggered on the NASDAQ. I think so far in the last 6 months, we've seen 50 Titanic, syndromes triggered on the NASDAQ. It's literally beyond anything we've ever seen before. But when you look back at other periods of time where you've seen these types of breath warnings, anywhere near these levels, it's been, near intermediate term trading tops. So late 2021, October 2007, and spring of 2000 are the ones kind of where you've seen, there's the smaller ones too, kind of prior to Volmageddon, late 17, early 18, we saw, a number of these types of warning signals creep up, not near to what we've seen. But, 2018 was a really difficult year for the market, where we had Volmageddon in January, February. And then the fourth quarter of 2018 was a very painful decline in stock prices. So I think between what insiders are doing, what these breath warnings are telling us, that this is very likely a blow off top, and we're in for some much more difficult sledding for the market over the next several months.
Unemployment figures, they've been moving off the low on the regular lately. It's recently ticked up to 4.1% with no metrics to point to that suggest that this new upward trend won't continue. At what point in this process, in this cycle, do you think it'll feel like we're in a recession? And as unemployment continues to rise, what degree of issues are you expecting in terms of, when it comes to real estate, like foreclosures and housing supply to come on the market?
That's a tough question. I think, when will it feel like recession? I think it all depends on where you are on that K, right? I think if you're on the bottom of the K, it already feels like recession. It's already very painful. I think the higher up you are on the K, maybe never feels like recession to you. But at some point, it's going to hit enough people to where it's obvious that the economy is broadly in recession, and I think we're trending in that direction. We're more it's starting to climb that income ladder. I think in terms of the foreclosures, that's difficult. I think there's so many people who have locked in ultra low interest rates. I mean, you think about if you have a below 3% mortgage, 2.75, 2.9, whatever, and mortgage rates, even if interest rates fall, don't come back near those levels. Even if you're kind of in dire straits, you're going to do whatever you can to kind of protect that mortgage and protect that property, especially because people have so much home equity right now, right? I mean, the home values have gone up so much since, in the last 5 years, since pre-pandemic, that I think it's going to be difficult to really get the stress in the housing market like we saw back in 2009, 10, 11. That said, I think there is this kind of Airbnb segment of the real estate market, which is at risk.
Mm-hmm.
I think we've already seen, weakening among, in a lot of areas for those folks. And we don't really know. I mean, I don't really know how much of the housing potential supply out there is, these Airbnb type of investors. And if they come under a certain amount of strain, how many properties are going to come on the market from those folks? So that's a different kind of dynamic. But I think traditionally, just traditional homeowners all these folks who've locked in great rates and have a lot of home equity, I don't think they're going to, we're not going to see the kind of jingle mail like we saw in 2010, 11, just for that reason.
There is an interesting new program that has either been released or set to be released soon, where homeowners will be able to tap home equity. Have you heard about this?
Yeah, I've heard that. I think it was Freddie or Fannie or both were going to start buying home equity loans or lines of credit. I think it was home equity loans, which would make the market way more liquid, right? It would be a lot easier to get a home equity loan if banks who are originating them didn't have to keep them in the portfolio or try and securitize them and sell them to investors. They could just sell them to Freddie and Fannie. That would obviously do for those home equity loans what it did for mortgages for years and years now. So yeah, I mean that would make it a lot harder for people to. I mean, because you look at, and I mean that's what companies are doing right now, right? With these payment in kind loans, they're saying, "I'm not going to pay you any interest right now because I can't afford it. But when the loan is up, I'll pay you all the interest and the principal at once." And why? I guess if companies have the ability to do that, why shouldn't homeowners have the ability to do that too? Like, I can't afford to make my mortgage payments right now, but let me get a home equity loan and I'll pay the payments out of that until things get better. And so, I mean, it would put some strength under the real estate market, that wouldn't otherwise be there. Now, having said that, I really do think there's a major problem in real estate. I really do feel for first-time home buyers who are dealing with not only high interest rates, but incredibly high real estate prices. It's really not fair. I think it's a situation of the Fed's making. I think we can all look back and blame Alan Greenspan to an extent, but then all of his successors that have kind of followed the same policy of, let's boost asset prices to create a wealth effect to support the economy. And the consequences of that are you have now a huge segment of the economy that maybe will never afford to be able to buy a house. And you understand why there's some growing social unrest in the country.
Yeah, and I could see that coming to a head. You know, you talked about your children, my children too. It's the first generation that can go to college, get 1 or 2 or 3 degrees, come out, get a very good paying job, and cannot afford to buy a home.
Yeah.
That's going to become a problem at some point. Do you see any innovation or breakthrough coming in the next 1 to 2 years that can help us innovate out of the problems that we face? Or is a collision with the debt, with recession, et cetera, really the only pathway that makes sense?
Well, I do think there are a group of people out there who do believe that generative AI is going to create a productivity boom that would be very, very bullish for the economy and help us grow the economy in a way that might help us address the debt from that respect. I don't see it. When you talk to the companies that are trying to implement a lot of these things, they're saying that hey, we've looked at a lot of this stuff, and I mean, Goldman Sachs has put out an interesting research report. They said they've been using generative AI to kind of do a lot of their data analysis, and it's pretty effective, but it costs 6 times as much as having a human being do it. So it's I mean, the thing with the internet boom was that it was a huge cost saving mechanism, right? If you're Amazon, you say, okay, we don't need bricks and mortar bookstores anymore. We can just ship from warehouses and save you a ton of money. There's a huge business opportunity there. There's no business opportunity in saying, let's switch this from human beings do it to generative AI doing it and spend 6 times as much money, right?
Right.
It doesn't. So that doesn't help with productivity. In fact, it's the opposite. And so I just don't see that. But that seems to be what a lot of people are kind of banking on in terms of bailing us out on a lot of these issues.
So it's not there yet. Likely will be one day, and maybe sooner than we realize, but in the next 1 to 2 years, likely not. And so therefore, as we come face to face, as the metrics and the data continue to churn downward, and we come face to face with, I mean, I hate to say it, like it's, suspenseful, but like a reckoning in a way, then, we're going to have to deal with the recession that's coming. And maybe in the future, a future cycle will get bailed out by the innovation of generative AI at that point.
Yeah, and I think it might not even be generative AI, right? Generative AI is these large language models and things that basically take a string of data and are able to predict, based on that string of data. But a lot of people think that this technology is going to lead to, artificial general intelligence, which is
Right.
people confuse with the generative AI, and that's basically just computers thinking as problem solving as well as human beings. Now, from everybody that I've listened to and have read, that the technology behind generative AI will never get us to artificial general intelligence. It requires a completely new method of achieving that, and it won't happen anytime within the next few years because we're still trying to figure out how we might even solve that problem. So generative AI can do these language models. It creates a much better search engine. I'll give it that.
Yeah.
We can do you can do image generation and things, even though there's hallucinations and problems with it that make it difficult to rely on for industries that need precision in any shape or form. And there's some benefits there, but it's not the revolutionary technology that I think people are really hoping that it will be. At least that's what I hear from, even Bill Gates and Roger McNamee and, tons of people in the industry who've watched this stuff, Gary Marcus, experts in the area who are excited about, generative AI, but also recognize that it's actually very limited in scope and much more limited than the hype around it suggests.
Well, that increases the probability then of the backside.com style crash that you were talking about. So, Jesse, in the last few months, gold's broken out of a 4-year consolidation zone under 2,000. It's now over $2,400 an ounce. Central banks, as you mentioned, they're buying more gold than any time in history, including the 1970s. Gold has reached a high in every currency on earth, and citizens in China, India, and the Middle East, and many other nations, they're buying gold hand over fist. However, the Western investor hasn't participated in gold yet. What's your position on gold? I think I know you. I heard you talking a little bit about it a moment ago, but what role do you see gold playing in the global financial system moving forward? What is your expectation as it pertains to the Western investor and their investment in gold over, say, the next 12 months or so?
I think that if we are, and it seems very clear that we are headed towards a new rate cut cycle, this breakout for gold is for real. I think it's a very bullish thing that we don't see the typical signs of investors embracing it at all, Western investors. If this were kind of a top, even a kind of an intermediate term top for the gold price, it'd be the first one that I've ever seen that is completely absent any signs of retail involvement at all. I mean, I look at the different types of sentiment signals, whether it's the miner's performance relative to gold, it's silver relative to gold, it's the investors' interest in ETFs. It's the discount, on to net asset value of some of the Sprott funds. They all suggest that there's zero interest on the part of Western investors right now, which to me is a very, very bullish sign. And all the previous kind of spikes in the gold price that we've seen, like when it first took off in early 2016, you saw chasing by retail investors. And that was a sign that, okay, well, this move is not really sustainable. Too many people chasing it, too many people going after kind of the smaller, mining stocks, too many people buying, maybe calls on, silver, whatever, on the ETFs. We're seeing none of that right now. It tells me that for the first time since this bull market began in 2015-16, this is a very sustainable move to break out to the upside. I do think the rate cut cycle is a really important part of that dynamic. I use a price analog where I basically just overlay the current price trend in gold over that 2017 to 2022, 21, time frame, and you can see the Fed starts raising rates, gold goes into a slump, but about 6 months before the Fed is done raising, gold prices start to pick up, and we saw that again during this cycle. And then right before the Fed, maybe a few months before the Fed starts to cut, gold takes off and breaks out. And so gold's telling you where we're headed in the monetary cycle, and it's kind of discounting the direction that Jay Powell and co. are headed. And before this move to the upside is over, you're going to see participation on the part of Western investors. But that's what's going to drive the next leg higher.
So with the AI explosion we've talked about requiring massive data center build out, the electrification of everything, the boom in solar panels, the rising advanced weapons manufacturing globally, and so many other factors, the silver demand is steadily rising. And this is at a time that supply is flat. It's leading to a fourth straight year of extremely large supply deficits in silver. At the same time, the price of silver is over $30, which hasn't been seen since 2011. What's your position on silver?
Silver, for me, I look at it as kind of a high beta play in the metal space. So if I'm bullish on gold, you could play that through the silver. If you wanted to, look at higher beta plays, I do think, yes, it is very interesting, the kind of the industrial uses of silver. Especially in an environment, yes, where we're seeing the electrification of everything. You make some good points there. I think that maybe creates an extra bid for silver that's not necessarily there for gold. But the fact that silver prices have been relatively subdued relative to gold, to me, is just another sign that sentiment really hasn't gotten anywhere near the place that you would expect to see kind of a topping in prices. So I personally, and I get no benefit from mentioning it, but I like that Sprott silver, gold and silver physical trust. It used to be the Central Fund of Canada. It's the only place I've been able to find where you can buy essentially gold and silver at a 5% discount to market prices. So, to me, as long as there's that 5% discount there, it's a really good sign that investors really have no interest in owning these things. And that makes me, from a contrarian perspective, very bullish.
So you mentioned the miners a moment ago. The miners have always participated in every bull run, and every large bull run, they have exuded leverage over the metal and done extremely well. This time, the metals have broken out. The miners have still kind of lagged behind. Where are you on the miners in this cycle?
Yeah, and I'm very bullish on them. It's been amazing to me to see a stock like Agnico Eagle, which is such a high quality company, trade at such a discount to what I believe is, fair value. As just a pure value investor, I look at that thing and go, this is, I'm buying dollars for 50 cents, buying this stock. And, classic margin of safety type of investing in a name like that. But I think you can safely extrapolate that across the sector, that because investors have shunned these things so much, they don't reflect the current gold price at all. I do think, that's why investors are staying away from the sectors. Everybody looks at this, the chart between, supposedly gold prices and real rates, and they say, oh, wow, gold's overvalued. I just don't buy it. I think we're in a different environment, that the environment that people have gotten used to over the last 30 years, this disinflation, dominated by disinflationary trends really since the early 80s, that environment's over. And the breaking out of interest rates out of that 30-year downtrend is probably the clearest message you'd ever want to see, that the environment of the last 30, 40 years is over, and you're in a new world now. Toto, we're not in Kansas anymore. And so
Right.
To be using these types of signals that worked over the last 10 years and assuming they're going to work going forward, I think is a big mistake. But yeah, I think the right now, the fact that the miners are so cheap relative to the metal, and so cheap just on their own, based on the earnings and things that they're creating, is very bullish. And I think that if you believe that gold price is even going to stay steady, these stocks are buys. And if you're bullish on higher prices in the metals over the next several years, I think you have to be rip snorting bullish on the mining stocks right now.
That's a good way of putting it. Some would say that while the Fed has the the sole ability to be the printer and print new currency, some are now saying that it's the miners who are going to be the printers of the future.
Yeah, if you think about the money they're going to be able to make in an environment where inflation remains sticky and the Fed is forced to through fiscal dominance service the needs of the Treasury over the needs of its mandates, especially the inflation mandate, then yeah, I think investors are going to, if they come around to that conclusion, you're going to see a rapid change in sentiment towards these things, where they're literally, nobody wants to touch them right now. Mm-hmm. It's going to switch from something like that to like nobody owns enough of these things in that type of environment.
Yeah, well, that can get crazy. Yeah. So, Jesse, according to many studies, the transition to greener, more sustainable transportation and the electrification of everything is impractical. Is not practical because copper mine production just can't keep up with the rising global demand of it all. Some estimates say the world needs 55% more copper mines to meet the production. There's a huge projected and growing deficit for copper beginning next year, and it goes all the way out into the 2030s. What's your position on copper?
I'm watching copper very closely because it, they call it Dr. Copper for a reason. And I think, copper to me is a better predictor, less of economic growth than of inflation. And, my friend Tom McClellan has pointed out, copper prices lead CPI by a couple of months. And so if that's the case, we were talking about inflation earlier. this resurgence in copper prices that we've seen over the last couple of months suggests that inflation is going to turn higher again. And so, that's one of the main reasons why I watch copper. But I also think it's interesting from an investment standpoint, just as part of, it's one part of this commodity super cycle that, as you point out, demand is only going to continue to grow for the stuff, and it's limited in supply, and not just naturally limited, but also limited by the lack of investment. And so, but these are the dynamics that are true in in almost every market for hard assets that you'd want to look at. And it's just fascinating to me to see these things do well over the last 5 years, 10 years in the case of precious metals, and still there's no interest in them. Right? It's like it makes me wonder, how much do the prices of these things have to go up before investors really, sit up and go, hey, I need to participate in this. And I think we're going to find out.
That'd be wonderful. Well, this has been an incredible conversation. And before we wrap up here, and I asked Jesse our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, the economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive you've enjoyed the conversation with Jesse as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video. All right, it's now time for the Golden Nugget segment, Jesse. Let's discuss portfolio positioning. And knowing that you're not a registered financial advisor, based on all we've discussed today and with your experience and your worldview as a backdrop, how are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay away from?
I'm very concerned about big tech stocks right now. I think they trade generally, the Magnificent Seven stocks trade about 50 times free cash flow right now. An average of 50 times earnings, right? What does that discount? That discounts a massive earnings growth. In fact, if you look at the long-term earnings growth that's embedded in the stock prices that are, by analysts, put out there, they're discounting, the highest earnings growth that I think we've ever seen really since 2000. And so if that doesn't, that's what's now priced in. So to the extent that doesn't materialize, even if they get good earnings growth, but not this unprecedented earnings growth, that's going to represent a disappointment. Yeah. And I think this is why we see, massive insider selling by people like Jeff Bezos and Michael Dell and Jensen Huang and Mark Zuckerberg, is that they recognize that what's priced in now is very difficult to achieve. And if this FOMO driven boom in AI investment turns to bust, that earnings disappointment is going to be massive. And so I think that, not to mention the fact that all of the buying has been driven by the most leveraged products ever invented by Wall Street, zero day to expiry options, and leveraged ETFs, 2 times, 3 times leveraged NVIDIA ETFs, and these types of things. There's a lot of leverage behind this trade. And so I think this is something that I'm concerned about over the next 6 to 12 months. Is I would be very, very cautious towards these names right now.
So that's what you're staying away from. Is there? I'm assuming that you're recommending or buying yourself. You're buying gold, maybe energy names, things like that.
Yeah, I've had a very large gold position really since 2015, 16, and I haven't really diminished it much at all. I haven't really had cause to, because we haven't really seen the kind of over exuberance toward it that would get me cautious, like we see in big tech right now.
Right.
But I think what I'm really most excited about on the long side right now are the oil and gas names. Oil prices have picked back up recently, and typically the relative performance of energy stocks follows the oil price. So oil prices are going up, energy stocks outperform the S&P 500. We've seen over the last 3-4 months is the exact opposite, where we've had oil prices go up and energy stocks have actually underperformed the S&P 500, which is a very big clue that investors are unduly bearish on energy stocks. It was something we saw in the fall of 2020, was something really similar, and that was a wonderful time to be buying energy stocks. And I think that when you also see, I mentioned Warren Buffett buying Occidental Petroleum, Carlos Slim buying PB Energy, the guys who do this, who have done it better than anybody, are buying energy, and that's all they're really kind of interested in right now. Insiders, kind of the same thing. It's really the only places I see any insider buying to speak of. And so I think energy is a very compelling opportunity right now.
Jesse, thank you for coming on to the Metals and Miners podcast. I could talk to you for hours. I appreciate your generosity with your time, your analysis, your ideas. It's been incredible to spend this time with you. Would you please share with the viewers what's the overall theme you want to leave those with tuning in, where they could learn more about your work, and how they can connect with you?
Yeah, I think that the main thing to kind of keep focused on, it's so easy to get bogged down into kind of the daily or even hourly trading in the markets and kind of lose sight of the big picture. And I think that capital cycle thing is something I try and stay focused on. What area of the market is being overly saturated with capital, because that's where I want to stay away from over the next few years. And what area of the markets have been starved for capital, because that's where the returns are going to be. And I think that's what is very clearly driving this commodity super cycles. These companies and industries have been starved for capital for years, and it's not something that just creates a 1-year trend or 2-year trend. It creates 5-10-year trends, and I think that's something to kind of keep in mind as we kind of look at investments and markets and things. And it's kind of stuff I write about at the felderreport.com is my website, and I try and tweet a lot of the stuff that I'm reading on, or I guess post to X, I guess is what we call it now. It's just at Jesse Felder.
Wonderful. So I'm going to put all of that information up on the screen. I'll have it in the description of the video as well. Everybody really needs to go and follow Jesse. Jesse is a stable wealth of information, and his outlook on the market is really, it's unbiased, data packed, he gets behind the data. And I really appreciate you, Jesse. And I really appreciate your voice in this space. I look forward to having you back on, and thank you for being here with us, and everybody else, thank you for watching. I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, the economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.